Welcome to our deep dive into business valuation. Today, we're going to cover various valuation models, understand their applications, and tackle some real-life examples to solidify your grasp. Before we begin, it's important to understand what valuation is. At its core, valuation is the determination of the worth of an asset, business, or company. Let's start with one of the most common valuation methods, discounted cash flow analysis, or DCF. This method estimates the value of an investment based on its expected future cash flows, which are adjusted for the time value of money. The core equation for DCF is the sum of all future cash flows divided by the discount rate. Mathematically, it is expressed as this. Imagine a company expected to generate $100,000 annually in cash flows for the next 5 years. If the company's weighted average cost of capital, WACC, is 10%, the DCF calculation would look like this. The next valuation method we're discussing is the comparable company analysis, or comps. This approach involves comparing the company in question to other similar companies within the same industry. Key multiples often used for comps analysis include price to earnings, PVE, enterprise value to EBITDA, EV/EBITDA, and price to sales, PES. For example, suppose our target company earned $4 million in EBITDA. If comparable companies trade at an average EV/EBITDA multiple of 8x, we would estimate the target company's enterprise value at $32 million. Now, let's discuss the third valuation method, precedent transactions. This approach looks at prices paid for similar companies in the past, adjusted for the current market environment. Imagine two similar companies were acquired recently, one at 10x EBITDA and another at 11x EBITDA. If our company's EBITDA is $5 million, using the average multiple of 10.5x would suggest a valuation of $52.5 million. Let's also briefly discuss the market capitalization method, typically used for publicly traded companies. Market cap is calculated by multiplying the stock price by the number of outstanding shares. Imagine a company with a stock price of $50 and 10 million shares outstanding. Its market cap would be $500 million. In real-life valuation scenarios, professionals often use a combination of these methods to triangulate the most accurate value. It's essential to understand the strengths and weaknesses of each method. For example, DCF might provide a solid estimate based on the company's cash flows, while comps could offer context within the industry landscape. Precedent transactions might then add a layer by showing how much similar companies were valued by the market. Knowing when and how to discount cash flows, selecting the correct comparable companies, and adjusting for market dynamics in precedent transactions provide a broader and more accurate valuation picture. To practice, here's a question. If a company has forecasted its cash flows to be $200,000, $300,000, and $400,000 over the next 3 years, and its discount rate is 12%, what is the present value of these cash flows? The answer would be calculated as follows. Present value equals $200,000 slash 1 plus 0.12 caret 1 plus $300,000 slash 1 plus 0.12 caret 2 plus $400,000 slash 1 plus 0.12 caret 3. This equates to approximately $178,571 plus $239,406 plus $285,435, summing to $703,412. By mastering these methods, you'll be well equipped to value companies accurately. Thank you for joining us in this deep dive. Don't forget to subscribe and leave your questions in the comments.